Hey folks, how we doing today? Really enthusiastic about the upcoming exams. That's what's up.
Yes.
Yes. All right. I love the enthusiasm levels. I don't know. So one of those exams are one of those things that I don't particularly enjoy exams, and I'd love to get away with it. Get away with not doing exams. I've tried it and it doesn't work. That being said, when a student does well on an exam, you know, you're like, oh my gosh, I'm so happy for you. When a student does not do well on exams, it's like my heart goes out to you. I feel there's like the level of connectivity. And I say that not necessarily exclusively to this class, but a lot of our graduate students are getting CPA exam section results, you know, and you know, the ones who did well, you can see this excitement shine on their face. And you're just like, yeah, kudos to you. And the ones who didn't do well, it's like, so you get them next time. All right. So I promise I won't say you'll get them next time on this upcoming exam, because that's not what we're going to be doing. I'm not going to give you multiple times to take the exam, but that's okay. Everybody will do well. Everybody will do well. So before we get started, I have some announcements. First of all, this is something I will try to remind you about, but I will probably forget, so I might want to make a note of this. We do not have a second executive in residence coming. I know we said we were going to have one, but it turns out our second executive in residence, hotel chain manager, and on the day that we scheduled that presentation take place, they had another meeting come up. It was for the Brazil World Cup soccer team, and they're going to be using one of their hotel chains for the World Cup visit. And I was like, okay, I guess we can go ahead and accept that that's a bigger priority than visiting Truman. So there's no executive residence. If you attended the first one, you can use that for your professional interaction. If you did not attend that one, there's still opportunities. There's plenty of opportunities. One that I think that you should probably put on your calendar if you really want or really interested. We have Aspire Energy. It's going to be coming to visit Beta Alpha Psi on the 26th. It doesn't matter if you're a member of Beta Alpha Psi or not. I cleared it with Dr. Beers, and she said she'd love to have anybody who wants to come and listen to the presentation. The guy who's probably presenting, his name's Andy Karcher. Really good guy. He's a former alum of Truman State. He will talk your ear off if you let him. So, but very charismatic individual, loves to talk about Truman, loves to talk about Aspire, and will share a lot of information about what they do there. So I think that's a good opportunity. So that's March 26th. I'll try to get you updated details. There's a lot of other opportunities. Basically, as long as you approve it with me, then you can probably do just about anything. The only time I really say no to professional interactions, when somebody says, well, I'd like to talk to my dad. I said, so your dad's not currently a part of your professional network? Like, you know, my mom is 83 years old. She's still part of my professional network. So yeah, so that's kind of the criteria we want to operate from, is that somebody not your professional network interacting with. Second thing, we're up to date on grading on all the assignments up to the exam. There are a few comments on Brightspace. Even if you got full credit, please make sure you take a look at the comments and go through some assignments. A few of them may have been said, you're getting full credit this time, but please do this in the future. I will expect you to do this in the future, okay? Whatever it might be. A few of you had missing items that we gave full credit for, but I basically said, I know the intention was there, but we need to specify what it is. A few of you may have missed a few points. Again, as long as you get those fixed before the exam, then you're fine. You're good to go. But please make sure you're diligent about that and check all those before the exam. Once the exam rolls around, there's no takees back. That's the term for it. That's the accounting term for it. That's what it's called. Anyway, let's go ahead and get started on the exam review. We've got a lot to cover. So as far as the exam, what I recommend strongly is when we come in on Wednesday, first of all, make sure you have a writing implement. I strongly recommend a pencil and eraser. You can take the exam with pen. There's no rule against it, but if you want to change answers, it becomes very difficult to do. So that's kind of my default, is pencil and eraser. You probably want a calculator for this first one. I think this is the only one that you will need a calculator for, but it's just good to have. Question always comes up: can we use our phones to a calculator? The answer is no. If you forget your calculator, you can probably borrow some info from somebody, or the calculations are not particularly difficult. So I assume we still teach longhand calculation. I don't know. I'm one of those people that if I get what's 1,000 times 6, I have to pull out a calculator for, just because that's the way my brain works now. So could I still do the longhand calculation and longhand multiplication? It's been a while. So if you really want to be a hero, bring a calculator that you plan on using, and then bring a spare small calculator, like one of those props that you get going to professional visits, like they give out by the ACCT, like those. The reason for that is if you're main calculator, the battery goes down, you want to have a backup. And if somebody doesn't have a calculator, you get to be the hero. So that's always a good thing. Multiple choice breakdown. There will be one question on chapter one multiple choice question on chapter one. There will be one multiple choice question on chapter two. There will be a whopping four questions from chapter three. There will be 3 questions from chapter 4 and 3 multiple choice questions from chapter 5. So basically an equal representation between chapters 3, 4, and 5 with a few ancillary questions coming from chapters 1 and 2. The only reason there's more than 3 questions on chapter 3 is that the problem will come from chapters 4 and 5. So you'll still want to emphasize those. 3, 4, and 5 are going to be the specific areas of emphasis. I've already said that the chapter 5 is really important for this exam, but far more important for the context of the entire course. A lot of the stuff that we're learning in this part of the course, we're going to roll forward into future parts of the course. Audit testing, audit documentation, all that, the things that we talked about in chapter 5, those are going to be really important moving forward. So that's important to note. All right, so let's do the breakdown of information on the study guide. I'm going to repeat it once more. I am not covering everything. I'm going to go over this very quickly. If there's something I do not cover and you need clarification on, please raise your hand and ask, what about this? Can you please tell me more about this, or ask specific questions? You can do that while I'm covering it, or we can do it at the end of the study guide review and wrap up. All right. So first thing to remember, principal-agent relationship is kind of predicated on 2 things. There's a separation between the owners and the operators of the organization. The owners of the owners, and then the operators of the managers of the executives organization. That leads to something called information asymmetry. So everybody remember that term from our first lecture? So information asymmetry basically says that the people who operate the organization have more information than the people who own the organization, which creates a big problem because they don't necessarily have the same incentives. People who operate the organization may want things that are in the short term or they might want things in the short term that are not healthy for the organization in the long term. So we're an alignment mechanism as auditors, but it all stems from that concept of information asymmetry. The management audit assertions, we're going to cover those a little bit more in detail in chapter 5, but my rule on this, whenever you see a list like this, if I list everything out, it means know it. When I say know it, I don't mean memorize it, I mean know it. You need to know the names. You need to know what they all represent. You need to know how they relate to the evidence that we've talked about. We talked about in chapter 5. The assertions about transactions and events. Remember, the easy way to remember this one is that it's everything but rights and obligations. The assertions about account balances at period end. That's everything but cutoff and authorization. If you count authorization as an assertion, I guess I put it on the list so you could, but I'm not going to test you on that assertion in all likelihood. All right, moving down. Please make sure you remember the 3 fundamental concepts of conducting a financial statement audit. I know all 3 of these are things that we cover in specific chapters. We talk about materiality in chapter 3, audit risk in chapter 4, and evidence in chapter 5. But it's important to remember that those are 3 core concepts to how an audit is conducted. So remember those. 4 types of audit reports. So we've got unqualified. When an unqualified report basically says everything is fine. There are no problems. The financial statements are free from material misstatement. What is this called from if it's a non-issuer company? Does anybody remember? Unmodified. Very good. Unmodified. Okay. Qualified is basically saying there is a problem, but it's a small problem. It's material, but not pervasive. This can arise in one of 2 ways. The first way is that there can be a material departure from generally accepted accounting principles. Second is that there's a material limitation of our scope. A material scope limitation. What does those 2 words mean, scope limitation? It means that we as auditors could not do our job properly. So we were supposed to observe them counting inventory, and we couldn't do it. That limits our scope, limits our ability to do our job. Adverse is reserved for pervasive departure from GAAP. It means it's so large that it does affect the financial statements. By the way, I kind of skipped over this. What 2 words should you always look for in a qualified opinion? Except for whatever the issue is, the financial statements are free from material misstatement. What about adverse opinion? Adverse opinion is exactly opposite language. Our statements are free and all material are properly represented in all material respects, the financial position of the company. That's unqualified opinion and adverse opinion says the financial statements do not present fairly in all material respects the financial position of the company. So it's the exact opposite of a clean opinion. By the way, you hear me spouting language off. You do not need to know the exact language. You should be able to hear it and know what opinion is being rendered, but I'm not going to ask you to replicate the language. Not yet, anyway. That time is coming, all right? But it's not for this exam. You should be able to recognize based on the language, but you don't have to replicate it. Disclaimer of opinion. Disclaimer of opinion arises when there's a pervasive scope limitation. So significant inability to do our job as auditors. We were not able to do our job, so we did not issue an opinion. There's also another ancillary situation when there's lack of independence, but we're going to get more into that in chapter 18. Don't worry too much about that right now. All right. Last thing I want to talk about is this thing called major phases of the audit. It's one line in the study guide. It is a very important line in the study guide. Please, 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 please know the phases of the audit. Okay. So let's go ahead and run through these. The phase we're going to talk about, we're starting chapter 3 is the planning phase. Okay. The planning phase, that's basically what we're doing. We're setting up the plan and the overall strategy for the audit. Still technically within the planning phase, but I treat it as a separate phase just for purposes of understanding, is risk assessment. That's where we're trying to understand what is it that we need to do as auditors? What does the scope of our work need to be based on what we observe from the client's operations? All right. Once we get past risk assessment, that's when we start actually doing detailed tests of assertions. Okay. So we start doing detailed tests of assertions. This first phase of that is going to be test of controls. And we start talking about other test of assertions where we can actually cover both transactions and events and account balances. That's substantive procedures. Substantive procedures has two subphases. Remember, two subphases. That's going to be substantive analytical procedures and substantive test of details. Then we have something called audit conclusion, which we're not going to really get into too much about detail about that. That's for the second exam. We'll talk about audit conclusion. And then we have reporting. Reporting is where we issue our reports. Now, there's two important things that I want to talk about with respect to those phases. You should know all those phases. What you should also know with those phases are which of those phases can we gain assurance? Like which of those can we actually do some sort of testing that will give us assurance about the opinion that we're going to render at the end of the audit? So that's going to be risk assessment, test of controls, and substantive procedures. The risk assessment, test of controls, and substantive procedures are all assurance gathering phases. And then there's two of these that we can test assertions specifically. Out of those three phases that I just talked about, which of those can we test assertions specifically? Test of controls and substantive procedures. That's not too relevant right now, but it will become extremely relevant when we start talking about specific tests here coming up in chapter 6, and later on when we talk about specific tests as they relate to the business areas specifically. So what's the difference? So remember, assurance is just a general level of information that we gather about the audit. Assertions specifically refer to management assertions with financial statements. So we specifically test management assertions during test of controls and substantive procedures. All right, moving on to chapter 2. The only things that I really want to talk about in chapter 2, I want to talk about these three items right here. These are all defined in the slides. Please make sure you take a look at their definitions. We kind of glossed over them in this first chapter, but they're very important concepts with respect to the operation of an audit. We're going to talk about them more in depth immediately after the first exam and then moving forward throughout the course. The due professional care, professional skepticism, and reasonable assurance. Due professional scare would be really weird. Yeah. Like go into the audit, want to make sure our client is intimidated. Yeah. All right. Also, please make sure you understand the information about ethics, professionalism, and the code of professional conduct. So keep in mind our litmus for how we actually conduct ourselves during an audit is dictated by this thing called the code of professional conduct. This is a set of rules created by the ACCT that say if you are an accountant who operates in assurance or auditing, these are the rules you should follow. We are going to have a specific lecture. We're going to talk about those rules. But right now, you just need to know those are the rules that are being followed. Chapter 3. So client contingents, why might an auditor leave an existing client? There were two reasons we talked about. The first of these is that contentious disagreements or contentious relationship with a client, they basically fight you at every turn. Second reason is that we have disputes about the fees, right? Disputes about fees. Either one of those might be a reason that we leave the client. They have to be significant. They can't just be passing issues. Like the state client said that he disagreed with my assessment, but then did it anyway. I'm leaving this audit now. You have to be very contentious disagreements. All right, the engagement letter. Engagement letter represents a contract between the client and the auditor. There are three sections that you need to know about the engagement letter that always have to be present. First of these are the objectives of the audit. First of these is the objectives audit. It's the section. Second section is management responsibility. And the third section is auditor's responsibility. Now, is it enough to know just those three sections? Or do you need to also know what management responsibility and auditor's responsibility are? Probably be a good idea. So let's reiterate that. So management's responsible for the preparation and presentation of financial statements. They're also responsible for the design and implementation and maintenance of internal controls. What you should think about that, you should say the creation of these items is management's responsibility. The creation of financial statements, the creation of controls. They're the ones who are responsible. We'll get more into the details of that as we go through the semester, but all you really need to remember right now is they have to create the financial statements, they have to create the controls. Auditors are responsible for checking those items, for testing financial statements and testing the internal controls. Those are different responsibilities. I will start using more specific vernacular moving forward. I will say preparation and presentation of financial statements and design, implementation, and maintenance of internal controls, but you don't need to memorize that vernacular right now. Okay, audit strategy. I'm just going to mention a note of this. So the scope of the engagement reporting objectives and the focus on team's efforts. I would take a look at chapter 3, section 1 slides, slide number 11. It's titled Audit Strategy and Plan. Had a list of items. You don't need to memorize that list of items. That's not what I'm asking for, but please make sure that you're familiar with all of those things that we talked about on that slide. Some of those we talked a little bit more at length, such as materiality and related parties. Some of those, that was the only point during the past 4 weeks that I actually mentioned them. So you may want to make sure you take a look at those. Speaking of related parties, first of all, we have responsibilities auditors for related parties to make sure that the client discloses this. If a client fails to disclose that they had related party transactions, is that a violation of generally accepted accounting principles? It is indeed, okay, and that affects the auditor's opinion. One thing that we're concerned about is whether or not related party transactions are representative of arm's length transactions. What's our arm's length transaction again? Basically, if you engage with somebody you don't have a previous relationship, you shake their hand at the end, okay? That's the distance we're looking for right there, because a related party is a lot closer. Related party is a big hug, okay? So that's how we think about arm's length transactions, arm's length. Phases in audit testing. All right, we just talked about this. I can't stress this enough. This is very important to make sure you understand all of these. Remember, there's a difference between the phases of the audit and the phases in audit testing. The difference being is phases in audit testing specifically refer to phases that we gather assurance on the engagement. And we'll come back to this because we're going to talk about all the different types of procedures that we can gather or we can perform here. With respect to materiality, there will almost likely be a materiality question because Dr. Barnes loves materiality. Okay. Please make sure you review the Wilson-Adam materiality guidelines. Remember, that was that Word document that was associated with the EWC assignment. Please review that. I'm not going to say that I will apply those guidelines, but you should be familiar with how the materiality is determined in given situations. All right. So I would recommend that's a good template for it. Make sure you are also familiar with the difference between quantitative bases and qualitative factors. I will guarantee there'll be a question on that. I think there was one on the practice exam. There will be another one on the actual exam itself. So what's the difference? Quantitative base determines what is going to be the number that we use in the financial statements to determine materiality. What is our general guideline in this? They call our rule of thumb on this one. Okay. Well, 5% of pre-tax income. Okay. That's our general guideline. You need to know that guideline. You also need to know what are some other possible options when we have different criteria. Like if we've got a not-for-profit, pre-tax income, not really good for not-for-profit. Okay. So make sure you have some familiarity. You don't need to know the relative percentages. I will give you a kind of percentage range if I want you to calculate that, but you should be able to identify identify different materiality bases. Then we have qualitative factors. These are things that will change the percentage that we use. To what direction does this usually go? Usually goes down. It's very rarely that this goes up. Okay, so if we start at 5% as our base, we will adjust downward for things that create significant risk. Okay, create additional risk in our procedures. Right. There was actually a big long list of this. Again, do not need to memorize it, but I would be familiar with everything on the list. All right. There was actually a really good slide on this that talked about the quantitative bases and the qualitative factors. Take a look at that slide. Make sure you're familiar with that. All right. Chapter 4. So audit risk, inherent risk, control risk, detection risk. It probably goes without saying that you should know all of these extremely well. Okay. You should know what all these represent. You should be able to define these. You do not need to use exact terms for definitions. You just need to give me a general understanding of what it means. I gave you some pretty simple guidelines. If you're somewhere close to my simple definition on that, that's going to be good. Also, of these, auditor technically has control over 2. Audit risk is going to be one that it controls, but I'm going to say that that's really kind of a misnomer because what do we know about audit risk? It's always low or even lower, okay? So it's pretty much a constant. So the 3 remaining, which one does the auditor have control over? Detection risk, yes, okay. Inherent risk and control risk are functions of the entity and its environment. All right. Make sure you understand the relationship between inherent risk, control risk, and detection risk. I probably should also say audit risk goes in there, but again, since audit risk is a constant, it doesn't really affect the others. It's really important to understand that as inherent risk and control risk is higher, detection risk is lower. Do we like low detection risk? It sure sounds like something we should like. We hate low detection risk. We hate low detection risk. Because low detection risk means we have a low tolerance for risk. It means we have to do a lot more work. Now, if you're one of those weird people that really enjoys a lot of work, then maybe you're just like, more auditing work, yeah. But I'm really, really lazy. So I'm going to be saying I hate detection risk, okay? So on the other hand, what do we say about high detection risk? That sounds bad. Is it a bad thing? No, high detection risk is high appetite for risk. It means that you can actually tolerate a lot more risk, a lot less work. So understand those relationships and understand the intuition behind that. Right. We'll get back to these up here. Suffice to say, for risk assessment procedures, make sure you know these items. By the way, of these 4, 3 of these are used in every single phase of the audit. Which one are they? The top 3: inspection records, documents, observation, inquiry, analytical procedures. What word should I have in front of this, by the way? Preliminary analytical procedures. Okay, preliminary analytical procedures. All right, categories of fraud. Make sure you can define fraudulent financial reporting and misappropriation of assets. Misappropriation of assets is easy to define. What is another word for that? Theft, okay. Fraudulent financial reporting, a little bit more difficult. It's basically a misrepresentation of an organization's financial position in their financial statements. I'm going to throw this out here because this always, I'm not going to say I always ask a question about it, but it always causes confusion when I do ask questions about it. The difference between factual, judgmental, and projected misstatements. I'm not going to go over those, but I did go over those during our lecture. If you've got notes on those, make sure you're familiar with those 3 different types of misstatements. If you don't have notes on those, go back and take a look at the lecture to make sure you look at that discussion. Okay. Simply because if it is on the exam, I don't want any confusion to exist. All right. There are very 3 distinct concepts, but they sound very similar if you don't look at that information. All right, conditions indicative of fraud. So our fraud risk factors also representative of the fraud triangle. This is something we talked about in AIS. It's still the same, okay? The 3 factors that all have to be present for fraud to occur: incentive or pressure, opportunity, or attitude rationalization. Make sure you're familiar, you can define those, and you can give me practical examples of each of those. Now, you can choose how you want to do it. If you want to use the costs case that we talked about in class as an example, that's fine. If you want to use cheating in a classroom as an example, say when rationalization is Dr. Barnes is a giant jerk, okay? Now, whether or not that's a true statement, that is a fair rationalization, okay? So that's going to be the way that you should approach this. All right. So communication, last thing, with communication of misstatements or fraud. If management's the one committing a fraud, who do we report to? The audit committee, okay? Audit committee. So we always report to management unless it's going to be management's the source of misstatement or fraud. We go one level higher. If it's the highest level of management, we report to the audit committee. Chapter 5, this is the big one. So management assertions again. All right. So let's just go ahead and list these out since we've got some time. All right. We don't have a lot of time, but we got some time. All right. So we have our big 3 assertions. First one is our recording assertion. Recording full stop. What's that called? Completeness, okay? Then we have the opposite of completeness. It basically says something's recorded, but we don't know if it actually took place. What is it? It's an occurrence. Okay, one of these moves from bottom to top, one of them moves top to bottom. Which one's bottom to top? Completeness. Which one's top to bottom? This is occurrence. Okay. Then we have our third big assertion, which basically says are recorded properly. What is that called? VAA, valuation allocation accuracy. All right, those are our big three that represent most of our situations we're going to talk about, but obviously I'm going to test you on all assertions. Number four is basically representing assets and liabilities in the balance sheet. What is that called? Rights and obligations. What's unique about rights and obligations that no other assertion could claim? So it's only in one category of assertions. It's only in account balances. Okay, that's what's unique about rights and obligations. Then we have the PCOB assertion that basically represents whether information is properly disclosed in the financial statements. What's that called? Presentation. Okay. Then we have something that's related to this, but it's ASB, an ASB assertion, auditing standards board assertion, that basically asks is our items are reported in the correct accounts. What's that called? Classification. Good. And then we have our final quote unquote assertion that basically says, did something get recorded in the proper period? Cut off. Yeah, it's also an ASB assertion. We have our eighth assertion. It's the secret assertion, which only Messier, Glover, and Pratt tell us about. When's that? Authorization. Okay. By the way, cutoff and authorization, which again, probably not going to test you on that. I would say 99.9% likelihood I won't test you on that. But if for some reason my hand slips and I write authorization on the exam, I don't know how it would happen. I have to actually type it out. But cutoff and authorization are limited to transactions and events assertions. Okay, those are the two limited to transactions. Okay. Concepts of audit evidence. Please make sure that you're familiar with this. If I ask a question, it's going to be a short one. It'll either be a short problem question or it'll be a multiple choice question. But this is one that kind of gets overlooked because we only cover it a little bit. And it's honestly not going to be as important, but I do think it's important to make sure that you look at. So nature of evidence, which is basically accounting records or not accounting records, sufficiency and appropriateness, which is quantity and quality, and evaluation. How well does this evidence hold up against versus other? All right, phases and testing. We're going to talk about the phases and testing here in a little bit more detail because we're going to go into a little bit detail about what evidence can be collected during those phases. All right, types of evidence audit test. I'm not going to go through each of these, but well, actually, let's just go ahead and go quick through. So inspection records document is pretty easy. Remember, we have vouching and tracing. Vouching and tracing test specific assertions and actually list those. What's the easy way to remember? Remember, vouching points down, okay, which is basically top to bottom. No vouching and tracing is existence occurrence. That's the directional test for that. Tracing points up. Completeness is bottom to top, so we know that it's test of completeness. Inspection of tangible assets. That's looking at an asset to make sure it's confirmed. All right. Observation and inquiry. Those are just as they sound. We see somebody performing a task, or we ask people about their task. What do we know about the reliability of these two particular types of evidence? They're very low because people can lie or people can behave differently when they know they're being observed. So we usually have to corroborate those types of evidence. Confirmation. What is the way to define confirmation? Third-party request. A third-party request. What do we also know about confirmations with respect to their test of controls? We never use confirmation as a test of controls. All right. Recalculation. Just recalculating something provided by the client. Reperformance. Reperforming a task performed by the client. These two in inspection of tangible assets, what's the reliability of those tasks? Very high. Why?
The auditor's creating.
Auditors do the work. Auditors do the work. And then analytical procedures. Analytical procedures. 3 phases for analytical procedures. Risk assessment, preliminary analytical procedures. Substantive phase, substantive analytical procedures. And then end of the audit, final analytical procedures. 2 of these are required. Which ones?
First and last.
Yeah, preliminary and final. Substantive is not required. It's just generally a good idea. Also, it's important to note that in addition to be able to define these, you need to know what is the respective level of reliability, and the one that's going to be a really big knockout punch that everybody gets really, really frustrated about. You have to know which assertions they test. Fortunately, you have a spreadsheet that kind of dictates all that out for you. All right. Now, let's go back. Risk assessment. There are 4 types of evidence that we can test. 4 types of procedures we can perform during risk assessment. 4 types of evidence we can gather. What are they? 3 you should know right away. Inspection records documents. Observation, inquiry. Okay, what was the 4th one that we looked at just a while ago? Preliminary analytical procedures. Okay, 4 types of evidence we can collect during risk assessment. Test of controls, we can collect 4/5. Okay, let's talk about the 4 that are listed up here. Okay, what are 3 that you know are right off the top of your head? Vector record documents, observation, inquiry, all phases. Okay. What is the 4th one? It's one that's almost always reserved for test controls. Give you a hint. It's one of the re's. Re-performance. It's almost always a test of control. Okay. There was a 5th one. Does anybody remember the name of that 5th one that I said was a secret one? Called walkthroughs. Okay. And you may say, why aren't walkthroughs listed on the type of evidence? Because they're just a combination, a fancy combination of all the evidence, all the types of evidence we gather. So walkthroughs are basically a combination of inspection record documents, observation, inquiry, and re-performance, which is why they're a 5th type, but they're not really unique. All right. With respect to substantive procedures, we have 2 subphases, substantive analytical procedures and substantive test of details. For substantive analytical procedures, we can only gather one type of evidence. Which type is it? Give you a hint. It's in the name. Analytical procedures. Don't you hate it when professors ask you really, really simple questions like, that's a stupid answer, Dr. Barnes, I refuse to answer. That's fair. It's fair. During substantive test of details, we can collect everything else. All of the other types except for analytical procedures, because we just did analytical procedures up here. So all the types of evidence with us down here. Okay. Is it likely we'll use all types of evidence? Not necessarily. Re-performance is rarely used during substantive test of details, but it can be used. Any type of evidence can be used here. All right. Again, very, very important. Not only to just know these, but know the relative levels of reliability. What was the acronym that we use for reliability? Does anybody remember? AEIOU. Auditor-generated evidence, external evidence, internal evidence, oral evidence, which is observation inquiry. And then you know it. All right. I find myself saying that more and more and getting less and less disgruntled every time I say it. I'm becoming old. All right. Moving on, audit documentation. So remember, we see the word work papers or working papers. That's the same thing for documentation. There are 3 functions. Make sure you know the key words for all 3 functions. Support, aid, review. Okay, support in the audit report or support the audit report. Aid in planning, performance, and supervision of the audit. Provide a basis for the audit review. All right, formatting for documentation. There were 3 things. Remember I said I thought this was the most important slide with respect to documentation. Make sure you review that slide and make sure you know what examples of these all are. I pulled out a work paper that we're going to be working on at the very end of class, and I said, look, this is a header. This is an example of indexing. This is how we would cross-reference with an index, and these are tick marks. There were all examples in there. Make sure you're familiar. You can define what each of these are. You can identify what each of these are and how they're used in audit documentation. All right. Analytical procedures. This always causes some turmoil, okay? Always causes some turmoil. My expectation is if you've done a calculation previously in accounting course, you should be able to do that calculation in this course, okay? So might I ask you to do a depreciation calculation if I give you all the variables? First of all, I'm not going to ask you to do makers, okay? I'm not a heartless monster, all right? All right. That's not say if you do that in a class. We haven't covered it, and makers is really, really specific in the context. But if I asked you to do straight line depreciation, do you think you could do straight line depreciation if I gave you all the variables? I may ask you to do a calculation that you've done in another course that we have not specifically done in this course, okay? I have very high confidence that you are able to do that. It's not meant to be complex. It's just meant to be an application. So if I ask you to develop an estimate, it's going to be something that you should be able to reasonably do an estimate on, given your current level of knowledge. Now, if you come to the exam and you're just kind of like, Dr. Barnes, I have no idea what's going on here, I'm going to feel really, really bad, okay? But in the past when I've done this, it's not been a big deal. So I do expect you to be able to do an analytical procedure. What is the key distinction or understanding if an estimate developed from an analytical procedure is close enough to the actual amount? What is that term called? Tolerable difference. What's our rule for tolerable difference? 5% of the recorded amount. 5% of the recorded amount. Okay. So if you do an analytical procedure, please remember that you also have to present the tolerable difference as your judgment criteria. That's something that you have to understand. Please make sure you review the EWC items, and I'm not going to likely ask you something about the wave, but I may ask you some of the takeaways from the wave. So make sure you're familiar with the ideas of inherent risk, control risk, and auditor responsibility. All right. Are there any questions? Let's get to the exam then. Yes.
You said something earlier that transactions were everything but and account balances were everything but cutoff. What was transactions for everything?
So transaction events are everything rights and obligations. Yeah, and account balances are cut off and authorization. Listed below are the 4 types of opinions that can be issued a PCOB report. Which of the filing opinions is a different term by the Auditing Standards Board? Which one is it? Unqualified. What did we say that one was again? Unmodified. Yes. Okay. What is the name for the set of rules created by the AICPA that detail the ethical and professional responsibilities for public accountants and in particular auditors? This one's an important one that we're going to cover later in the course, but what was that set of rules called? Code of Professional Conduct. Yes, Code of Professional Conduct. This is just remembering understanding, which is why we're not going through each of the answers. So, which of the following tasks should an auditor complete as part of the determination of whether to accept or prospective a client for an audit engagement? So this is a little bit more detailed. This is asking whether or not we would do this. Now, it's important to note, when you see questions like this is a phase question. What phase does this particular question imply? This is a planning phase question. You can tell because it's the beginning of the audit or beginning of the exam, okay? Because I'm going in order of the chapters, all right? Yeah, I won't mix them up for you. So we need to do something that's going to be part of the planning phase. So let's go. Document the necessary scope of substantive testing. If we are determining substantive testing, it assumes that we've already completed test of controls, correct? So this is obviously not going to be something in the planning phase. Evaluate the operating effectiveness of the client's internal controls. That sounds like test of controls. So we're past the planning phase. Make certain inquiries the client's predecessor auditor. That is a planning phase step, and that is exactly something we talked about as part of making the determination for whether to accept it for a prospective client. All right. Request the client's legal counsel provide information about any reported contingent liabilities the auditor is aware of. Remember, I said that this answer always comes up. It's always the end of the audit. It's always misused. Yeah. Remember, this is the end of audit. It's the audit closing or conclusion item. Consider the items listed below: competence, due professional care, objectivity, and value. Which of these are items that are factors the external auditor must evaluate when assessing the reliability of the internal audit function? So there are 3 items that we had to assess. 2 of them are listed up here. Which ones are they? Competence and objectivity. Competence and objectivity. What was the third one, by the way? Systematic and disciplined approach. Very good. Okay. Which of the following statements regarding the audit committees is correct? So let's just go evaluate all these statements. What do you say? An audit committee is comprised of a subset of all the entity shareholders and creditors. Is that a true statement? That is not. What's the problem with that? It's the subset of the entity shareholders, but the subset of that subset's subset of a subset is the board of directors, not creditors. Creditors are independent owners, but they're not part of the shareholder. An audit committee for a publicly traded company is subject to regulation under SOX must be comprised entirely of financial experts. No, how many financial experts do we need? Uno. All right. An audit committee for a publicly traded company that is subject to regulation under SOX must include at least 1 member of company's management. No, the rules say that it must be outside independent board members, which means 0 members of company's management, 0 members, 0 employees of an organization. There are no specific composition requirements for an audit committee of privately held companies. If you go back and look at the slide that we talked about in audit committees, that's actually one of the boxes in the top left-hand corner. I can visualize it in my head. Okay. But we talked about there are no rules for private companies, only for public companies. As a general rule, auditor calculates planning materiality of 5% of pre-tax income for its audit clients. In which of the following situations might the auditor use an amount other than pre-tax income as the basis of planning materiality? So this is a quantitative based question. When might we use something other than pre-tax income? So the client is a privately held for-profit or profit-oriented company. Would pre-tax income still be okay there? Yeah, privately held doesn't make a difference. They're still profit-oriented. Client operates in a mostly unregulated industry. This is a qualitative consideration. This would actually affect the percentage that we use, not the base. Same thing for the client said material misstatements in prior year audits. That would affect the base, okay, not the percentage or the base, or I'm sorry, the percentage, not the base being used. Client is a financial services or firm or mutual fund. Would this affect the base being used? Yes. Because remember, in asset-based entities like the ones being described, we probably want to use some measure of assets as our base, not profit. Auditor may be subject to or exposed to financial loss or damage to his professional reputation from litigation, adverse publicity, and other events arising in connection with audited financial statements. What is the term for this type of risk? So you notice it's not part of our audit risk model. I didn't want to conflate any of the items in audit risk. This is something that we said was independent of the audit risk model, but related. What was that term called? Engagement risk. Engagement risk. We had a very graphic example that I will not repeat, but it's engagement risk. Good old Cressy's hypothesis. Okay. Cressy hypothesis says that trusted persons are aware that their problems can be secretly resolved by violation of the position of financial trust. Of the three fraud risk factors that we talked about. Corruption is not one of the fraud risk factors. It would be weird if it was. Which one does this most closely represent? This is opportunity. This is opportunity. They're actually listed in order, but I didn't list them in order down here. I alphabetized them. So remember, conceive of themselves having a financial problem, which is not shareable. That's pressure, and aware to apply, are able to apply their own conduct, situation, virtualizations, and able to adjust that conception of themselves as trusted persons. That's attitude or rationalization. Okay, that's how we distinguish that. All right, some assertion questions. Auditor decides to test a sample of client sales transaction to ensure that sales were recorded in the proper period. Which management assertion is the auditor testing? That's cut off. This is a perfect example of cut off. By the way, it may come up. So I asked you a couple of questions in the practice exam that were direct examples of assertions. I might flip it and I might say, which is an example of, or I might say, this is the assertion. What's an example of this assertion? So be able to interpret both directions. I also may be very, very sly, and I may ask you to interpret something where I don't give you the assertion directly, but you have to look through the answers and determine, based on the answers given, which is the assertion and how does it apply in a given scenario. So be very, very familiar with examples of assertions and how they relate to the assertions. So again, knowledge of the assertion is really important, not just memorization. Okay, we're good. As part of testing client's property, plant, and equipment, auditor determines it should verify management assertion of existence occurrence related to fixed assets that are acquired over the past year. Which type of audit procedure will provide the most reliable evidence related to this assertion? All right, so let's go ahead and go through these. Now, again, some of these are not going to be picked up because they're not as reliable, but you may notice that I've got some that are really high reliability. You do need to know two pieces of information. You need to know, first of all, what is the relative reliability level? And secondly, does it test the assertion that I specified? Okay. So what about analytical procedures? There are problems with analytical procedures in this scenario. There are two problems with analytical procedures. First of all, analytical procedures is medium reliability. Okay. Also, does it test existence occurrence? It does not. Okay. So we can't use it in either scenario. Inspection record documents. Okay. Does it test existence occurrence? Yes, it does. We call it vouching. Remember, vouching is test existence occurrence. What's the reliability level? Medium. It's very versatile, but not the highest level of reliability. Let's jump down to recalculation. Recalculation, what's the reliability level? Extremely high. The auditor performs the test. Does it test existence occurrence? It does not. It tests BAA only. Okay. So we have one left. Inspection of tangible assets. Reliability level is high, and it specifically tests only existence occurrence. Okay. So that's why it's the answer. Hopefully you didn't struggle with that, but there may be similar questions like that where you have to consider multiple criteria. So get in the habit of thinking about all the criteria, not just a single criteria within the question. Consider the phase of audit testing below. An auditor decides to send confirmations of sample clients, vendors in order to test the reported balance for accounts payables, during which, I've got that typo in there and I keep making a note to correct it, and I never do. During which phase of the audit is the auditor most likely to conduct this testing? All right, so are we going to conduct confirmation testing during risk assessment? So there are four types of evidence we can collect during risk assessment: inspection, records, documents, observation, inquiry, analytical procedures. What was not listed there? Confirmation. We do not collect confirmation during risk assessment. Are we going to collect confirmations during test and controls? No, never, 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 no. All right, never, no. Confirmations during a test assessment, during test controls. So we have substantive procedures left. Can we collect confirmations during substantive procedures? Yes, we can collect every type of evidence during substantive procedures. So 3 is our only possible answer. 3 is our only possible answer. All right, Sally Seidel, CPA, is preparing an analytic to develop an expectation of the previous year's sales revenue for a client to Broken Arrow Performing Arts Center. Don't you like that I told you that revenue analytics are useless on Friday, and then I give you a question on the exam that deals with revenue analytics? This is more about your ability to calculate. So the calculation breakdowns, they had 10 shows with the expectation of BFPUC's revenue. So going to be 64,000 in the orchestra, 25,600 in the balcony, and 12,000 in the mezzanine. You add those together, you get a show per show. You get 101,600. Multiply it times 10 shows, you get 1,016,000. Sometimes you just need a straightforward computation question. Is that right? All right. I'm going to switch over conversions here. By the way, the solutions to the exam should be available on Brightspace now. So if you want to get access to that, miss anything. All right. So we got Ryan Jackson. Ryan Jackson. Ryan Jackson. Heard those names before. Wait a minute. It's a Dr. Caden reference right there. All right. Didn't tell the priority of learning about taxation during college and didn't retain much from his auditing course. It's probably because of bad influences by Dr. Caden. That's all we're going to say. All right. So you're going to teach Ryan Jackson about fundamentals of auditing. So identify and briefly define the 4 components of audit risk model. So 4 components. What are they? Audit risk, obviously. What else? Inherent risk, control risk, detection risk. Okay. Audit risk. How do we define audit risk? So this is basically the risk the auditor says everything is fine when in fact there's a problem. They express an inappropriate audit opinion when the financial statements are materially misstated. That's audit risk. What is inherent risk? What's a simple definition for inherent risk? It's the fundamental risk to a business entity's operations. Okay, you go into business, you're subject to risk or any consideration of controls. What is a control risk? These are risks that are still present after the entity takes action to address its inherent risk. So we know the controls are in place. Every good, responsible organization should implement controls to address its risk. But the risks themselves may not work properly, or they may not be designed properly. If that's the case, then risks still exist. Those existing risks, those remaining risks, we call those control risks. And then we have detection risk. Who's got the responsibility for detection risk? The auditor does, okay? And these are any remaining risks after applying audit procedures, or any risk remaining after applying audit procedures. That was fun. What's an application of this? What do you guys say? Let's go ahead and do some application of this. So I gave you some examples that you're going to have to identify. So which one of these most closely relate to? Cat Corporation has inadequate supervision or review over petty cash transactions. What does that sound like? So supervision or review sounds like control. So this has got to be a control risk. Audit team for Rosen Incorporated did not perform confirmations testing over Rosen's receivables. As a result, the auditor failed to identify a material misstatement in accounts receivable. So the auditors did not do their job properly. Talking about something that's in the auditor's purview, the auditor's responsibility, that's got to be detection risk. Very good. Because the business model requires that it carries large volume inventory, E&L enterprises are susceptible to theft. That's an enterprise asset. Yeah, that's an inherent risk. Okay. Halter Technologies operates in an industry that's highly competitive and subject to rapid change. That is also inherent risk. Fundamental operation risks. Although the audit engagement team for Go Corporation was not able to obtain sufficient appropriate evidence to justify its conclusions, the auditor issued an unqualified opinion. What is this? This is audit risk. They basically issued an opinion that was not justified by their work. Yeah, audit risk. Okay. Sorry, the rest of it's a little let down. That was the high part of the exam, by the way. That was the fun part. All right. 2 components comprise risk and material misstatement. You should know this pretty easily by now. It's inherent risk and control risk. Okay. And then which component of audit risk model is the only one the auditor has control over? We just talked about that. We just said that's the auditor who has the responsibility for detection risk. Briefly explain the relationship between this component and the scope of testing the auditor must perform as part of substantive testing. This goes back to the idea of risk and material misstatement. Risk and material misstatement dictates the scope of our work that we're going to have to perform. Now, how does that work? How does this fit all into the big picture? So we assess inherent risk, we assess control risk. Based on the respective levels of those two, we set risk and material misstatements. Now, remember, I'm not going to ask you this necessarily. Well, no, I may ask you this specifically. I'm thinking about this. So if I say if I say inherent risk is high and control risk is high, what are you going to say for risk and material misstatements? High. Okay, it's high. What if I say inherent risk is high and control risk is low? The risk and material misstatement is low. Okay, because remember, risk and material misstatement is dictated by whichever is the lowest of those two. Okay, that was the club double I, DJ double I, yeah, club RMM. That was the example I used in trying to explain that. So whichever is the lowest is going to dictate that. So if I've got low risk and material misstatement, how do I perceive that as an auditor? Client's got low risks associated with their operations, or they've got really good controls that will mitigate risk. That means that they're going to probably capture a misstatement before it happens. So I have to do less work. So I set risk and material misstatement at low based on my assessment. That means detection risk is going to be high. Okay, remember, detection risk represents our tolerance for risk, what we can tolerate as auditors. We see high detection risk, we're like, yes, okay, because that reduces scope of the procedures that we perform, the nature, extent, and timing of our audit procedures. We have to do less work, less detailed, rigorous work. And we'll talk about the implications for that a little bit later in the course. But Right now, you just need to think about the stringency of our testing, the quantity of our testing is going to be significantly less. Flip the script. Error risk is high, control risk is high, risk of material misstatement is high. Detection risk is low, okay? Detection risk is low, we have a low tolerance for risk, which means, doggone it, we got a lot of work to do. So we're gonna have to do more work in our substantive procedures, which means that we have to expand the scope of our testing, we have to conduct more thorough procedures, more reliable procedures, it's gonna be more stringent, more detailed. That's how the interpretation is. A good definition of this would talk about how the risk of material misstatement is dictated, how that actually determines detection risk, and what that implication means for the scopes of our procedures during substantive testing. All right, that does it. Best of luck in studying. Feel free to come to office hours tomorrow if you have any questions. I'll see you all on Wednesday.